Good evening, everybody. Zoom has changed its features again, so if I appear to wait or stall, it's because I'm adjusting to their new features. So bear with me as we go, as needed. So my name is Daniel Young, and this is Adapted Perspective. Every week, we separate currents from noise and opportunity from fear using an income-focused strategy and closed-end funds. It's not polished, as you can see. It's certainly not scripted, and it's definitely not herd thinking. We don't chase headlines. We navigate markets. Now, let me be clear. I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets real cash flow, even when that means taking a different course. So, welcome back. I met someone new this past Friday, and eventually the conversation turned to the stock market. He told me what he was buying: Microsoft on the dip, watching growth, looking for value. A solid approach. But as we talked, something became clear. He wasn't chasing hype like the herd, but he was still chasing objects, just further down the road. And that's where we diverge. I'm not looking for the next shiny object. I'm looking for the current. I told him this market favors bonds. And that's where I lost him. He said, "Wait, what do you mean it's a bond market?" Okay, fair question. Most people aren't taught to think this way. So here's what I told him. Right now, there are four primary currents: bonds and select bond proxies, end to end energy, real estate, and technology beyond the large caps. All of them are moving, but not equally. Bonds are leading. Now back to his question: why bonds? You got to strip it all down. So if you can strip everything down and look at these points, GDP is growing, the economy is expanding, tax cuts were given and are now being experienced. Job markets are growing despite the disappearance of ghost jobs and the expansion of AI. And AI is forcing competition and lowering costs. That's deflationary. Energy production is increasing. That's deflationary. Rate cuts are being signaled in the midst of the stagnant Fedflation. In isolation, every line is just a data point. Seen together, the combination matters. Because when rates go down, bond prices rise and income strategies strengthen. That's not a guess or a prediction. It's just simply how the system works. Now, a quick clarification on bond proxies. It's where most people get tripped up. Not all income vehicles behave the same. For example, bonds and BDCs, or business development companies, are dependent income vehicles, but they behave inversely to the rate markets. They're both income players with starkly different personalities. BDCs do well in high rate environments and lose strength as rates fall, while bonds benefit from falling rates. That's why you can't just chase the yield. You have to understand the current behind it. And here's where the strategy shifts. My goal isn't just growth, it's income and positioning. I'm building toward, or I'm building forward. I'm building towards strong monthly income, consistent payouts, and assets that benefit from the next phase of the market. That's why I don't chase individual stocks. I use closed end funds. And I say this term all the time, but I haven't defined it recently. So let me attempt to define it briefly. What are closed end funds, or what are CEFs? Think of it as a collection of assets under one umbrella, like a mutual fund, except that fund uses leverage, pays a higher dividend, and generally pays monthly. Closed end funds are like that, but there's more. They're different from everything else out there because they have capped total shares. Now, recall the basic tenets of supply and demand. When there are lots of shares available, the price decreases. When there are fewer shares available, the price increases. Because of that fixed supply of shares, funds can trade at a premium, on par, or at a discount. So here's a context clue. Use $1 as the reference point. If you buy a fund for a 5% premium, that's like spending $1.05 on every dollar invested. If you buy a fund with a 40% discount, that's like spending 60 cents for every dollar invested. No one wants to pay the premium, and everyone wants a good deal. Now for the realities. Not every fund on discount is a deal, and not every fund in premium is worth it. Overall, CEFs, closed-end funds, allow you to pick up multiple assets at once that produce high income. The current dividend yield is over 9%. And instead of picking one stock like Microsoft that sells for over $420 a share and pays below a 1% dividend, you're buying a system of assets for under $10 to $20 a share, often at a discount, that currently pays you about 9% while you hold it. Now, here's the real difference in strategies. Most investors chase what just moved. They look for price appreciation and they wait to realize the gains. I'm doing something different. I'm targeting active currents, discounted funds, and monthly income. So the portfolio grows while it pays. So before we get into this week's snapshot, ask yourself, why are you investing? What are you actually trying to build? And are you following a strategy or following noise? Because the goal isn't to simply copy what I'm doing. It's to understand how to think about what you're doing. So with that in mind, let's move into this week's closed-end fund snapshot and look at the funds aligned with the strongest currents. And remember, the active flowing currents in order are not primarily, but just in that primary slot, bonds and select bond proxies, secondary end-to-end energy, tertiary real estate, and quaternary technology beyond the large caps. And to be quite honest, the secondary, tertiary, and quaternary categories are still bond proxies, but they've become so prominent, I've put them in their own boxes. So let's take a look at the list and see where that leads us. Share my screen. And interesting, I don't see there we go. Maybe it'll pop up now. Here we go. So this isn't the final list for the week. And I've been doing my due diligence in researching funds. Just an ongoing, one, it's an ongoing need for the system. Two, it's just an ongoing habit. I continue to love to learn, so I continue to delve. So I ended up with similar funds at the top, and maybe not similar funds at the bottom, but at the bottom of this list, we'll say. So NHS made the list last week, and I've done some digging, and it looks really tempting, but it's not quite as tempting now. I'm very willing to buy a risky fund, but I want consistent income. I don't want risky income. And too much risk, with great risk comes great reward. With low risk comes low reward. All of that, it's not that. When your entire portfolio was sunk into, I don't know, like an averse risk, you run the risk of sinking your entire portfolio. That's not my goal. So yeah, NHS looks amazing, but they've had their recent troubles, and as tempting as it sounds, it's not going to make my list this week. The same is true for SSL. And you can pause this and read this. I'm not going to read it to you. But an eroding NAV from not being able to pay your dividend, that's that's a little scary. So that leaves HCLB. And in a mixed market, like in a mixed signal market, where it's pointing at more than just bonds, it's a great fund. It's a little pricey for me right now, but it's a great fund because it hits a lot of the boxes. It it's got a bond component to the portfolio. It ticks the end-to-end energy. It ticks the real estate. It ticks tech and data centers, but it's also a stock fund. Like it's a great hybrid fund, but it is a little bit pricey for me in comparison to my buy-in level. And unless it just prevents a fantastic above average deal for the fund, it's not worth it. And you may consider, sure, 30% off is an amazing deal, as is 33% off. But for HGLB, the price has dipped a little lower recently, but the discount has been in the same range for a while. And as incredible as the 30% discount is, and with it still containing some stocks, and with me hyping and prioritizing bonds, it sounds a little duplicitous to leave it on the list. So I went all bonds for the week because that's the primary current. And we're prioritizing income and prioritizing money spent. It's really hard to leave anything else on the list unless it's got to be unless it just had a fantastic, amazing deal and it just didn't happen this week. So it's almost a handful of PIMCO funds and DLY again. So everything is in this black box because it's PIMCO, and I wanted to lump all of these comments together. But first, I will highlight these boxes so you can pause the video and read them at a later time. So no way am I going to read all of that to you. No offense, but you can read them yourselves, and that's really tiny writing. So the other stuff that I found out on PIMCO funds and these other little comments that I want to get to. Same thing, you can read them at a later time. So these five bond funds, all even though that four are PIMCO and one is not, they all have vastly different portfolios and focuses. They also all handle inflation a little bit differently. PIMCO, for the most part, handles inflation equally well in all of those four funds. And double line funds handle inflation different than PIMCO. That's not to say one is better than another. Um, and my comments are more in general. Like in general, PIMCO funds seem to do great with low rates and decent with high rates. And double line funds seem to do great with low rates and okay with high rates. Um, since we're trending into a low rate market, that puts all of the funds in a great position. And I'll be honest, we bought 2 weeks ago. I'm not buying tomorrow. My goal is to wait 2 more weeks and consistently get that month to month dollar cost average, unless the market randomly dips again. And sure, I mean, gosh, if the market dipped 20%, nobody would like it, but we would buy because it's a great buy in moment. But of the list, I mean, we own everything but PAX. So, and I tend to agree with this statement of everything I've read this week, this is what grabbed my attention the most. PAX traditionally sells at a significant premium, and right now it's on a discount. And this discount doesn't look like much. It's less than 1%. That's like paying 99 point what 73 instead of a dollar. That's pretty much paying a dollar. But that slight percent is actually pretty big in the grand scheme of things. But these are averages, like a 3% drop. I mean, That's significant. But the fund with the greatest discount or the greatest inverse, the greatest gap between the existing discount and the traditional discount is PTY. PDO has fared better recently than PTY, really because it's more aggressive. Um, but all of these funds are amazing deals on the current data. This one has the greatest disparity, that's the word, or the greatest gap between the existing discount and the average discount. But all are great buys. And if I was buying tomorrow, honestly, I'm not. I would be tempting to pick up PAX simply because I don't already have it. But that being said, I love these little monikers. PTY is the gold standard. Like PAX is a great blend, but really it's PTY and PDO. That's the focus. And PHK, if you can still consider a 12% dividend as a legacy fund and not as dynamic as the others, that's really impressive. But buying PAX, I mean, I would do some more digging, but buying PAX just seems to dilute my investment into PIMCO. It's not buying every PIMCO fund or every double line fund or every bond fund there is out there because at some point, dilution hurts you and diversification hurts you. It's the same concept as the line I keep referencing from The Lord of the Rings. Bilbo Baggins says, I feel like butter scraped over too much bread. When you spread your money or you spread your investment so thin, it doesn't grow, or it doesn't grow well, or it doesn't grow quickly. So to just spread money out and plug it into every bond fund out there just doesn't seem like a great idea. It's tempting to pick up PACs, but at the same time, I'd rather invest in something I already have. And it is a different portfolio than the rest. Like it's slightly different and it's a different angle and it's a PIMCO fund. So it traditionally sells at premium. But that's also a key difference. I'm investing for income and the coming market. I'm I know the market's going to go up and down, but the price point matters when I buy. But if I ever sell, the price point only matters when I sell. I track it week to week just to keep an eye on things. And everybody wants growth, but I also want I want the consistently paid dividend, so that regardless of what the market does, and we all know it's going to go up and down, that regardless of whether it goes up or down, I get paid. So I could hold it for a lifetime and get paid the whole way through. Or I could hold it up until the point I sell it. And whether I take a loss or a win, I still get paid the entire way through. So adding another PIMCO fund, as amazing as that sounds, I'm hesitant to do. I would really somehow have to dig into the portfolios and see how they're really similar or different. But since I haven't done that, it's really hard to make a rash statement, but I'll still make a rash statement and say that I would probably not invest in that, despite the language saying that it's an amazing current discount, because this still has the greatest discount gap between current and average. And this has been the winner for the last year. So I don't know if I've helped myself if I was investing tomorrow, other than saying that one wouldn't make my final list because I'm already invested in other places. As for you, I don't know where you're invested. And I'm also not investing for you. You've got to figure that out and figure out what's best for you. And you have to weigh the odds. Do you already own something? Are you considering about filling a gap that doesn't meet your that are you considering filling a gap in your portfolio in the sense that it's not just that you want another PIMCO fund or another double line fund. It's that your current bond fund is missing aspects of the market and you're trying to fill in the gaps, or you're just adding another fund because it's a PIMCO fund. That's different. I will freely admit that these three funds were on my hit list and wish list since I don't want to say since I started because I didn't really know a ton when I started. Let's say within the first year of starting, those three got on my list, and I didn't acquire them until recently because such is the market. Um, I noticed PHK along the way in PAX. I read a guy that loves PAX, but he also loves a lot of these other funds. So I don't know if this is helping you. Maybe it's not. On my end of things, I would not include it on my list for what I buy, but at the same time, I'm not buying tomorrow. And I hope I'm not being wishy-washy. That's not my point here. My goal is to buy 2 weeks from now. So if it was 2 weeks from now, what would I buy with what we have? And if everything was still the same, like I know the data points are going to be different, but if the discounts were similar, if the market was similar, all of the above, right? 2 weeks from now would be close to the new federal chair coming in. It would probably be a different market, but let's just say it's all the same. I would be tempted, kind of the what if scenario. You could say what if all day, but what if doesn't really matter. But what if everything was the same and just the dates are changed? Then I would still probably try to pick up 100 shares of each and come in under. Let's see, at 44.38, that is under. Um, and you probably pick up 200 there based on price. Let's see. Yep, 49.08, definitely under that. So there are some options. What I like about the spreadsheet is I can weigh the different options of how I want to do shares, and it'll calculate things on this annual dividend column. And yes, I made this. I made this spreadsheet, um, and quite honestly, you can make the same. But again, my goal is to get everything off the ground and running, and then share my resources. So for the time being, back to point. These top four make my list for the opening bell tomorrow. Not knowing what you have and don't have, and on your end of things, maybe PAX is a great idea for you. For me, it's not. It's a great idea, but it doesn't help me, or at least I need to dig a lot further and see if it could help me. Um, of the list, it's the most expensive. That's an easy way to outline it, although it does pay a great dividend. Um, so I'll say these are my handful for the week, but if it's just me, PAX doesn't make the list. So take it for what you will. So I'll leave you with this. We're here to find the current and stay in it, even when it's uncomfortable and even when it goes against what everyone else is doing. Everybody, well, I won't say everybody because saying everybody means I'm doing it too. Most everybody is pouring into technology with little thought to utilities, bonds, or the other bond proxies, right? So even when it's uncomfortable and even when it goes against what almost everyone else is doing, we are here to find the current and stay in the current. So, sure, you can chase reflections, but while you're doing that, the current keeps moving and the opportunity moves with it. So, filter the noise, watch the flow, let the current do the work, and get paid while it pulls you forward. That's all I have for this week. So, I'll see you next Sunday. I've got a busy week ahead. I'm sure you have a busy week ahead. So, whatever it is you're doing this week, whatever it is on that to do list that you have to get crossed off and done, I wish you access. Oh man, I wish you access. I wish you a successful week. Yeah, it's definitely not a man. These videos are not perfect. I would love to have a amazing perfect video, but it's not there yet. So whatever it is on your to-do list this week, I wish you a successful week accomplishing those things that you need to get done. And I wish you a successful investing week, even if you're not investing. If you're investing tomorrow, I wish you the best. If you're not, like me, I still wish you the best. Think through things, find the currents, find the flow, target the flow, and then tune the rest of all the nonsense out. So I wish you a successful week. There we go. And I will see y'all next weekend. Bye bye.